Welcome back to the channel, everyone. Today we're tackling a huge question. Can you really build a portfolio that allows you to quit your 7-to-3 or 9-to-5 job? Well, the truth is, yes, you can. But it takes discipline, smart investing, and the right strategy. In this video, I'm going to walk you through 4 powerful ETFs that can help you build passive income, financial security, and eventually the freedom to walk away from your job if that's what you want. The 4 ETFs we're covering are SCHD, Schwab US Dividend Equity ETF VYMI, Vanguard International High Dividend Yield ETF NOBL, ProShares S&AMP, P500 Dividend Aristocrats ETF SCHH, Schwab US REIT ETF. These funds are not random picks. They're carefully chosen to balance income, safety, and growth. So, if you've been dreaming about replacing your paycheck with investment income, grab a notebook because this video could literally change the direction of your financial life. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. Let's start with the basics. Why ETFs? An ETF, or exchange-traded fund, is a basket of stocks. Instead of buying one company and hoping it performs well, you're instantly diversified across dozens or even hundreds of companies. This matters because the biggest risk most people face is putting too much money into a single stock. With ETFs, that risk is minimized. Now, when it comes to quitting your job, the key is passive income. You need investments that generate money even when you're not working. Dividend-paying ETFs are perfect for this because they literally pay you cash, just for holding them. Let's put it into perspective. If you earn $50,000 a year at your job, and you want your investments to cover that income, you'd need enough invested in dividend ETFs to produce the same amount annually. At an average yield of 3.5%, you'd need around $1.4 million invested. Sounds like a lot, right? But here's the beauty. If you start early, reinvest dividends, and stay consistent, the snowball effect of compounding makes this very achievable. So now, let's break down each ETF that can help you on this path. First up, SCHD, Schwab US Dividend Equity ETF. This is, without a doubt, one of the most popular dividend ETFs out there, and for good reason. Expense ratio: 0.06%, which is dirt cheap. Dividend yield: around 3.5% as of now. Focus: high-quality, financially healthy U.S. companies with strong dividend histories. SCHD doesn't just chase high yield. Instead, it screens for companies that have solid balance sheets, consistent earnings, and the ability to grow dividends over time. Some top holdings include Broadcom, Home Depot, Cisco, PepsiCo. Now, let's talk performance. SCHD has historically outperformed many other dividend ETFs, and it's even kept up with the S&AMP, P500 in many periods. That's impressive because dividend-focused funds often lag in pure growth markets. But here's the kicker. SCHD not only gives you a solid yield today, it also tends to increase that yield over time through dividend growth. That means the income you collect 5 or 10 years from now will likely be much higher than today. Example time. If you invested $100,000 into SCHD, you'd currently earn about $3,500 in dividends annually. But reinvest those dividends, and in 10 to 15 years, you could be looking at $7,000 to $8,000 a year, without putting in a single extra dollar. That's the power of compounding dividends. Of course, no ETF is risk-free. SCHD is heavily concentrated in U.S. large-cap companies, so if the U.S. market struggles, your returns could dip. But long-term, SCHD is a rock-solid foundation for any dividend investor's portfolio. Next, let's move beyond the US with VYMI, Vanguard International High Dividend Yield ETF. Why do we need this one? Because diversification is key. The US market is powerful, but you don't want all your eggs in one basket. VYMI invests in high-yield companies outside the US yield, over 4%, higher than SCHD. Holdings: Nestlé, HSBC, Shell, Toyota, and more. With this ETF, you're exposed to different economies, currencies, and industries. That reduces your risk if the US goes through a rough patch. Now, there is a downside. International stocks can be more volatile, and you'll face foreign withholding taxes on dividends. But even with that, VYMI provides valuable income diversification. Imagine you invest $50,000 in VYMI. At a 4% yield, that's $2,000 a year, paid to you just for holding shares. Pair this with SCHD, and you're building a reliable stream of income that isn't tied to just one country. And trust me, when you're building financial freedom, that global safety net matters. Now let's talk about stability and consistency with NOBL, ProShares S and AMP, P500 Dividend Aristocrats ETF. This ETF invests only in companies that have raised their dividends for 25 consecutive years or more. That's right, through recessions, wars, inflation, market crashes, these companies still raise their payouts every single year. Some holdings include Coca-Cola Johnson and AMP, Johnson Procter and AMP, Gamble McDonald's. NOBL's dividend yield is lower, around 2%, but what you get is safety. These companies are proven survivors. They generate steady cash flows and reward shareholders through thick and thin. Think of NOBL as the backbone of your freedom portfolio. You might not get rich overnight, but you'll sleep well knowing your income is backed by some of the most reliable businesses in the world. Finally, let's add real estate to the mix with SCHH, Schwab US REIT ETF. Owning real estate directly can be expensive, risky, and stressful. SCHH solves that by letting you own shares in dozens of real estate investment trusts, or REITs, through one simple ETF. Yield: around 3.5% holdings, Realty Income Corp., Simon Property Group, Prologis. REITs are legally required to distribute 90% of their taxable income back to shareholders. That means they're reliable income machines. And the best part? You don't have to deal with tenants, repairs, or property management headaches. SCHH gives you exposure to retail, industrial, residential, and even data center real estate, all with a single click. Now let's put it all together. Here's a sample allocation. 40% SCHD, 25% VYMI, 20% NOBL, 15% SCHH. If you had $400,000 invested with this breakdown, you'd earn around $15,000 to $16,000 per year in dividends today. Reinvest those dividends, and in 10 to 15 years, that could easily grow to $25,000 or more. Push it to $1 million invested, and you're looking at $40,000 to $50,000 annually. That's enough to replace many salaries and walk away from a 7-to-3 job. The strategy is simple: invest consistently. Reinvest dividends early. Stay patient and let compounding work its magic. Now, let's be real. There are risks. Markets crash. Dividends can get cut. Inflation eats into your income. But here's the thing. If you're diversified across SCHD, VYMI, NOBL, and SCHH, you've already built in protection. You're not relying on one company or one sector. The biggest risk, honestly, is yourself. The temptation to panic sell during a downturn is strong. But remember, as long as those dividends keep flowing, you're still getting paid. Financial freedom isn't built overnight. It takes time, patience, and discipline. But the reward, never having to rely on a job you hate, is worth it. So what should you do next? Open a brokerage account with Fidelity, Schwab, Vanguard, or whichever platform you like. Start buying shares of these ETFs consistently. Enroll in a DRIP, Dividend Reinvestment Plan, to automatically reinvest your payouts. Track your dividend income growth every year. Set your target number. Maybe you need $30,000 a year to quit your job, or maybe it's $50,000. Whatever it is, work backward and build your portfolio step by step. So there you have it, 4 ETFs to quit your 7-to-3 job. SCHD for US dividend growth. VYMI for global high yields. NOBL for rock-solid dividend aristocrats. SCHH for real estate income. Together, they form a balanced, income-generating portfolio designed to give you freedom. Remember, wealth is built slowly. But once you reach the point where your dividends pay your bills, that's true financial independence. This video is for educational purposes only and not financial advice. Always do your own research and consult a licensed advisor before investing. If you found this video helpful, don't forget to hit the like button, subscribe, and share this with someone who's also dreaming of financial freedom. Thanks for watching, and I'll see you in the next one.